Okay. Okay,
Okay,
thank you.
okay, nice. All right, let's get this off. Let's get. Okay, now I got. All right. Okay, so let's look at value divergence. No, let's look at breakouts first, okay? Because one question of yours was basically if price successfully rotated, it doesn't mean this is a successful auction. It will treat successful if high of retracement broken. And then my entry from a 15 fib level of sudden move for a breaker is situated. So there is a simple exercise I used to do in the beginning. Let's just take some random market, like let's take the Euro futures, for example, like just for basic trading. Like you see, this is just basic price action, right?
Okay.
So what I do is now I will change my fib settings. I will just put it like this. I will put this here off, I put all this stuff off, and just have it like this. So I have the 1, I will have the 62. It's nothing really special, right? It's just for measuring. So you can see it's not really about the Fibonacci, but more about the measured moves.
Okay.
So you see we have now some weird fib levels except the 50, right? So what we're going to look at is now, for example, how to see an area where price can move away high, right? So this is how I started to see how a breakout really is. Basically, what we do have is now a swing low, right? This is a swing low. If I put the fractals on, I will just put the fractals on. This is my, where's the line gone? The line is gone, okay. For example, this is the day, right? And we don't see what's coming to the right side, okay?
Okay.
So we take just this range here. This is our daily range for now, right?
Okay.
I won't count this here in because it's not a swing low. This is the swing. This is not really a swing. So what we do is you take your projection, right? And you take it to the 50, right? So from here, it has to break the 50 and then it should pull back, right? So, oh no, wait, hold on. If we put it like this, wait, I have to remember, but I think it was something like this. So once this happens, yeah, you see? Okay, nice. So once this 50 breaks, you should await a pullback. Well, in this situation, it doesn't pull back, right? But it hits the standard deviation, right? The 0 level. So you can look at this as a type of profit take level. So you see, we get the stop, we get a fast move up here. If I put volume on, this is probably, it's not even a high volume candle, but you see it's a fast move here. So you always want to take profits at these type of candles, basically. So if you're long already, but if you're not long, it doesn't really matter. So let's see the example from the other side. Let's look at the short side of the business. You just take the same example. You take the swing high and the swing low, okay? This is not probably the better example here. Like I will just put it down the time a little bit more. Hold on, did it wrong. Swing low, swing high. This is the 50. Right, perfect. Okay, cool. So we have price like this, okay?
Okay.
I will delete this. So basically, this is just a 50. If I, for example, if I take the fib now and I just block everything out, right? From this swing low to this swing high, right? This is the 50 this here.
Okay.
So it doesn't make any difference. Like I said, it's not about the 50, but it's just to show you the concept of a breakout. So for example, if price, if you struggle to identify whether it's a breakout or not, right? So if it's a valid breakout, you see this is not really a valid breakout because it takes out this fractal low again. So this here is not a breakout because it doesn't go a certain distance.
Okay.
You understand? Like if this would go a certain distance, then this would make a valid swing point. But you see, it did a higher high, right? So, but it's not really a successful auction because it rejects from this high. And this is now becoming a successful auction to the downside, right? But you also see it fails to go lower, instantly breaks up this high. So yeah, this is just like, this is a little bit messy, so we won't look at this. You know, it's not always going to be perfect, but like I said, for example, if this is your 1, right? And this is your 50. This is your 0 level, basically, this swing low. So this swing high, this swing low, this is your measure, okay?
Okay.
Once price breaks below this 50, you want to look for the pullback. This is basically 1, this is 0, this is 1, 0, this is 5, okay, this is 0.5, I'm sorry. This is 0.5. I hope you can see it, right? So it makes sense, right? And this is your measured move of -1. Makes sense, right? Because this is 0.5, this got to be -1 then, because it's a half deviation, basically. From here to here, this is a measured move. Like if you take this here, duplicate it, this is the same move, right?
Yes, sir.
You see it? Okay, great. So look what happens. Price is doing what? Price is doing what? It breaks the 50, right? So you know, okay, this is a valid break of structure. What you look now is a pullback. Remember, the 50 is an
Yes.
area. It's not a line. It's not the single line. It's an area, right? So you have to be kind of mindful about this. Oh man, sorry. You have to be mindful about this because this is why I put these two levels on, because this is ultimately the 25 level. If I put the fib on and I just activate the 25 here, for example, like this, and I draw the fib out from swing high to this swing low, right? Other way around, like from here to here. You see, this is just a 25 level basically. So you see, it's not about the fib. The fib is just to help you, basically to assist you in your trading. So we know, okay, this is now a break of structure because this candle obviously traded lower, right?
Yes.
So we wait for what? We wait for a retracement. Even if it goes lower, yeah, it goes lower, it goes lower. You see, it goes lower, it comes higher, it comes higher. We're just really curious about this here, these two zones basically. And this is what you look for.
Okay.
See it, boom, it's done. Basically, this is your trade because even if it takes out this low, maybe it won't be successful, but this is like the perfect trade, right? This is the 25 level. Price is pulling back into the 25. If I take the fib now from swing high to the swing low, it's a 50 pullback, you see, basically. This is now the 50. If I just delete this here, it's just short above the 50. Or even if you take it like this would be even more better, right? Because this is now approximately the 50, and you see how it reacts from the 50, takes out the 0 level. And this is how you can anticipate the breakouts, basically. So you take it. Now I have to activate the other levels again. 61 was it? And you see how it goes for the measured move, right? Like here. Look how it reacts. It comes here, you take profits. So basically you enter here, right? Because this is your level to enter. I have to do it another color. This is your entry level, okay? You see it? And this is
Yes.
your profit take level. Let's take it below because this is ultimately in swing low. So you would take profits below this low at -1. And look what happens. Price is just rejecting here, coming back up. And now you can do the same circle basically all over again, because what you have here now is still in downtrend, right? So you would still look to sell the pullbacks. Now you do the same stuff over. You take it here, you take your fib. This is now your new balance area basically, because you have this swing high and this swing low. Once this 50 is broken, you wait for the pullback, okay? Let's say you don't see it. You don't see it. Like you only have this type of price action right now, okay? So you're waiting for the 50 to break, and this is your target level. This is just put down, and look what happens. Price is breaking here. You know, okay, the next pullback I want to go short, okay? Because now you know, look, you get up. Alert may trigger differently from what you expect. Got it, okay. Now look what happens. Look what happens. Do you see it? Look, it's pinpoint accurate. We didn't even see this price, right? We didn't see it because I wasn't showing it previously. I have some alert here. Remove this alert. But basically, again, same concept as before, right? Trend is obviously still down. So what you look at, 50 break, pull back into what? The 50 balance area. You see, it goes a little bit above it, but your stop loss will always be above this level here. So you enter with a trade like this, basically. You enter here, your stop is here, your target is here. You get a trade for what? 1 to 2, 1 to 2. That's okay. That's a decent scalp. This is a 5-minute chart in 1 day. So basically, effectively, you took 2 trades now. You took this short here, right? You took this short for this swing low. You exited here, you entered. Your trade was something like this. This is a 1 to 2, right? So effectively, you're +2 at the moment. And now you're +4. You're +4. So basically, you got a 2 to 4 ratio. This is, yeah, no, you got just, let's say you're +4, okay? Because you won 2 trades basically on this concept, just based on this concept, right? And look what happens here. This is okay. This is even today's market. All right. That's funny. I didn't knew it, but you see it, right? You can see it. I mean, I didn't cherry pick this. I didn't cherry pick this at all right now, because if you want, we can go back to any time. Like, let's do what is it called? Replay. Let's go to replay. Caution, this isn't okay.
Can you show me this in Bank Nifty? So
okay, let's try. This was now just for, you know, for example, but it works. It's just basic structure. Okay, so let's take a look. Let's go to replay. Can I go to replay? Let's go just 1 month back. Okay, can I go 1 month back? Yeah, I can. Okay, so we already know what's going to happen after this price, but let's say effectively, okay, I still got the fib levels. This is your 1, and hold on, let me frame this right. And this is your 5, right? This is your 5, this is your 1. So this is your balance area right now, this here. From, wait, where is the 50? No, wait, hold on. Wrong. Like here. We won't count the opening because the open is always volatile. We can, but it won't probably hit the target. We can try at least, okay? We can try. So this is the range, but more than likely this is the range, okay? This doesn't make any sense because this is not a range. This is just the open. It opens up aggressively. We need always a balanced area, so a consolidation. You always use this concept in consolidations, not in expansions. So what you want to see is, you want to see the break of the 50, and you get the break of the 50 here, okay? So effectively, you want to pull back into these 2 areas. Do we get the pullback? Do we get the pullback? Do we get the pullback? Yes, we do. See it? We get the pullback.
Yeah.
We already hit the target here, so I don't know if this makes a wallet target price, but you see, in the end, it's still a valid level, right? Because this is, if I just, I don't know if I can say fibs, but if I just take this swing high, right, and this swing low here, it's just a 50 level, you see it? Like, it's a little bit above the 50, but
yes.
It's just a 50 level, basically. But you see, this is your trade, and look what you get, man. You get like a huge trade.
This creates confusion, no? That if a price goes above 50, so there is a possibility of a squeeze. So
yes, you always have to think about building value above the 50 and not going above the 50, because it can just reject from the 50. Imagine this, okay? For example, just take everything off. You get this top, right? This is top price, this is the bottom price, and this is how the day starts, okay? Prices open up aggressively. Wait, I will just draw it like with the brush, basically. And this is the 50, okay?
Yes.
So this is called the higher hold and the lower hold, okay?
Okay.
So what you want is you take it like, for example, like this. So this is just for measured moves, okay? This is just for me to, whoop, hold on. This is basically a really simple concept because, hold on, to the 5, this is the measured move. So these areas should always be on your chart, okay? You got this balance area, you got 2 projections of -1 because price will go in either direction of this breakout, okay?
So I have to wait for consolidation.
You don't have to, you can jump into a momentum trade, but this is, I'm telling you, this is how you spot a squeeze trade, okay? So the squeeze trade is basically like this. Imagine price is going up, price is consolidating like this, right? It hits the high, it hits the low, it does this type of stuff. And at some point, once you see rejections from the 50, right, that price is like holding like this, and then it's holding the 25. Remember what I said, this is also in 50.
Yes.
And price is getting smaller and smaller. These buyers here, right, they will jump off because they see they can't rotate price above the highs. So what price will do is either test these levels, right? If value is especially down, and they will go for the -1 move. And from there, you can look to get long again, basically.
Okay.
So, and it's the same thing. If price is holding above the 50, it's building value, basically. You have to look at it like a shape, you know, like a market profile. This is like a P shape, okay? This is where the value is now, because first value was here, okay? This is fair value, fair value. Hold on, let me draw this. This is fair value, right? But what is fair value now? Because price is in the upper 50, right? So the 25, the 50 of this 50 must be fair value now. So this is a shift in value, basically. This is where all the value is. And if sellers are not able to rotate price down, they will just withdraw their liquidity. This is their liquidity, right? And if they see they can't rotate price down, they will just collapse the trade and try again higher. And what happens is price will just run up really quick to this price level. Now let's take a look at some of this concept, basically, because it's repeating itself, you know. It's like it's always the same type of stuff. Okay, like let's take a look at this bottom. Okay, how to capture this trade. Same stuff. You take the low, you take the high, the 50, right? Look, this is like textbook. This is, I don't say you have to take profits here, right? But you see, this is expanding. This is moving, right? This is moving. Okay. So let's mark out the moving parts. This is moving. Oh man, I hate these type of highlighters. But this is moving, right? So there's little chance to capture this trade. Okay, there's little chance to capture this trade. So you wait for what? You wait for a bounce from the bottom somewhere like this. If I probably take this 50, it will be a -1 projection. Like, you see that? Yes. Did I make this stuff up?
Yes, sir. This is now I am like this is.
I mean, it's you know what I mean, like, and look how the price is developing here, because I would just switch off the Fips real quick, because just to show you again the same concept. Look what price is doing, okay? I will just use arrows for this now. Price has got a swing low, swing high, right? Price is chilling below the 75, right? Look what price is doing. It's coming below the 50, right? Yes. Now it's bouncing from 25, and now look, this is like the last trade you can take. And look what happens after this green candle. Price is just going fast because these buyers here, they know, okay, I won't get price to rotate from here. I'm too early. So they will just withdraw. They will take their stops, right? They got buy stops here below this low, buy stops, by limits, I'm sorry. They got limit orders below this low. They want to buy it. But once they see that price is failing to rotate above the 50, they know the sellers are still in control, and they will withdraw the liquidity to a measured move. Like, it's really that simple. Like, look, you take this line, duplicate it, you get the same line, you can delete this, right? And look, This is your price level now for a buy. Look what happens. They step in, they stop the price. Probably you get some stopping volume in this candle here. You see that? Like low volume. This is all from this point here. From, let's say, from this order book sweep bar, right?
Yes.
This is all low volume. This is a seller's auction basically until this point, until this big sell candle comes in. But even this sell candle gets stopped by this little doji, right? So you see, this is basically the stopping volume. So you know, okay, a buyer stepped into the market because this is a measured move, right? You know, this is the bottom. You just automatically know this is the bottom. You can also say, okay, you know what? This is a buyer's auction because the volume is constantly dropping off into a lower price, right? You see that?
Yes, yes.
This is a seller's auction. This is a buyer's auction. I mean, you got buyer's auction, you get the stopping volume here, boom. Now look, let's say you didn't know all this stuff, okay? You just know, okay, this is my price prediction. This is like from here to here, this is the price prediction I got. So what you do now is, we don't look at volume. You just take the next step. You just look, okay, I want to see a breakout above the 50 from this line because we don't have too much price action, okay? We just have the swing low, the swing high, double fractal, bottom fractal, top fractal. You see prices rotating
Yes.
above the 50. This is the 50, this is the 25. You see, it's going for the squeeze. It's not, it didn't break yet. Now it broke out, right? This is a big break. Like you want the candle to close above this level. And look what happens now. Price is going up, price is coming down really slowly, going up, going down. And now look, you get your 25 test. You know, okay, you know what? I can buy this now because you get confirmation. And look what happens. Price is going up, price is going up, price is going up, and price is gone. And now, again, how do we determine this high, this top price? You just take this move here to the 50, and you get approximately an entry. I'm not saying you get the perfect entry, but this is where you want to exit basically. And look what happens after that. Does price move any higher? Nope, it just comes all the way back.
Okay.
You see it? Like, it's brilliant, man. I don't know what to say. It's almost brilliant. Like, you get this 50 area, right? You know, okay, this is my take profit level. It opens, the market opens, right? You get a little bit of extra. If you didn't all close here, you get a little bit of extra. You close it out here and you're done for the trade. Like, let's do another one because this is just, yeah, let's take this one. This looks good. This looks good. So we got our fib, we take our levels on. It was the 76, it was the 61, this was the 50. So this is just for exercise. Remember, this is just to practice. I want you to do exactly the same. You take these fibs, right? You take the swing low, swing high, and you project it like this basically. Wait, I have to go a little bit here just to capture this move here. You got the bias. You always have to take the bias with you. So where's the 50, man? I can't, here. This is your range, okay? You see, this is, you can now use this here, but I wouldn't consider this as a break because what it did was it just pinned it and rejected, right? So this is also not a really successful auction because it didn't held below that price. Let's look to the future. Let's look what will happen. Price is still going down, price is still going down, price is still moving sideways. We have to extend this area. Okay, cool. So we got something finally. We get a break of the 50 at the open, okay? This is one level you want to buy. This is one level you want to buy. This is the 50 level, okay? We don't know what's going to happen next. We mark it out. Okay, this would be a losing trade basically. You would have lost this trade. Maybe because this here, I don't know if this was already breaking, I can't tell, but maybe it was already breaking. Like, let me get this fib. If we take this here, but either way, it wouldn't make sense because it took out basically the high and the low of the market. So this is kind of a choppy day, to be honest. I don't know how I would trade this market properly, at least. Like if you take the swing high, swing low, here You got your 50 here. You got your 50 prices below the 50, then it pops up. It's just messy. So let's say, okay, let's don't count this in. Let's just look for another day. Let's look for the next day here. Let's look for a little bit of more price action. Okay, let's stop here. All right. So you take the last swing points. You take the swing high and the swing low. Basically, these 2 points. This has to be the 5. Okay, so we get the break to the downside. Here at this point it breaks, right? Now it comes back on the open, on the retest. You got this level here. This is your sell level. Basically, you can even sell on this here. This is your sell level. Your stop loss must be here. We check it. And this is now where you probably already exited the trade somewhere in here, because let's say you went short here, okay? This failed to take the target out here. So if it doesn't reach the target, you probably have to collapse the trade at some point, because, well, you see it broke here, right? This is where you want to sell. So it goes below this low here, but it doesn't come to the -1 deviation. So you need to go at least break even, you know? And the thing is, one thing you have to remember is if price is coming back up and it fails to rotate, right? This is now failed to rotation, FTR. Like, oh man, I wish I would have, this is now FTR, failed to rotate.
Yes.
You don't want to sell lower than this here. This would be just a no-brainer. You wait for a higher high to sell into. So basically what you get is this line, and now you can sell it, but the thing is, and again, you get a fail to rotation, right? It should take out this low or at this low, but it doesn't. So what it will probably do next is just, yeah, go high, you see? And here, again, it goes higher. Goes higher, it goes higher. So once you see this failed rotation, like this bottom with a big volume, right? What is this? Present from Zoom. Okay, whatever. You see this pin comes in on high volume, so there must be also, like, if I take this low from the swing high, it's probably the 75 level here. And yeah, it is like below the 75. Some people, they don't want to rotate price below this low, right? Otherwise they would have taken it out. So if they don't take out this price level here, you have to anticipate that it will go for the other side of the liquidity, because the market is always chasing liquidity, you know? This is the thing. And you see, most of the time it will go for the liquidity. You got here this higher hold. This is like the perfect example. I would just switch on now, switch off now, basically. I would just show you the P shape so you understand. This is like the P shape, because you see prices at this point. Let's take the swing low, the swing high, swing low. This is what I mean when I say P shape, because value is building up above the 50. There is no business below the 50. So somebody must be buying above the 50, and they only really buy at the VWAP if they buy at the VWAP, right? For example, this is the VWAP, right? You want to buy below the VWAP, so you would like to be a buyer here somewhere if you could spot it. I don't know how, maybe on the 1 minute, but you can front run the price in some point, because you see, if you take this high, this low here, you got the 50, you see prices basically, yeah, this is the squeeze trade, you know, this is called the squeeze trade. The squeeze trade is a higher hold. So again, it's the P shape. The P shape is this here. What it's doing is, there is no volume here. Like, volume is non-existing here. There is no volume. All the volume is going to the upper part, right? So this is a shift in value. Look, people are buying above the VWAP, right? And institutions, they only buy above the VWAP when they're really sure that price is going up. And look what happens at some point. If I now take the 25, right? Let me put the 25 in, you will see exactly the same concept. Basically, you see how suddenly the 25 is holding here, for example. You see somebody's buying the 25 even. Somebody stepped in at the 50 here. They stepped in at the 50 here, like from this high, this low. They stepped in the 50. They bought the 25. They stopped this liquidity out once. Perfect. Big bar into 50 level, high volume. The VWAP supporting. Boom. Prices coming back to the same level as here. Tested on low volume. You see that? This is now a low volume test, basically. So there are no sellers in this price. So you can buy this, put your stop loss below the 50, maybe put your, it depends on your risk appetite, you know, but now you just got this shift in value. Like you take this high, this low, again, you get this high now. This is basically, you're constantly shifting the 50 around because it's always about an auction. So once this comes back, this comes to the 50, this comes to the 75, the next day it just opens, boom, the trade is done. So you always have to think about the P's and B's. Like, for example, let's take a B shape, okay? Let's take a B shape. Let's go to a better time frame. This is a B shape. I can see it because it just shows you, like, if I put this here on, you see this is where the volume will be. You see?
Yes.
Why? Because we're below the 50 basically. So if you take this day here, you don't have to use this tool. I just have it so I don't have to always draw in the 50, you know, and for other things. But you obviously see there is a shift in value because look what happens from the 50, right? We have the swing high, the swing low, prices going up slowly into the 50. Rejection, it's going down, right? You see another rejection and higher rejection, it's going down. And look what happens. At some point, it's just every high gets sold basically. Look, 25, right? This is the 25 level. And at some point, the sellers, they just give it up, -1 projection. You know what to do. You know buyers are sitting here. You already know it, you know. I mean, look, you get the pin bar at the bottom, high volume, lower volume. This is basically stopping volume now because this is still some profit taking, but you wouldn't like to front run the price because price didn't hit your one-to-one measure, right? You see how perfect this is? It's literally perfect, man. Like,
What if I consider this balance area that
yeah,
the arrow? So
yeah.
that is also a balance area, if you say.
This can be a higher time frame balance area. Remember, we look at the 5-minute chart, okay? You don't have like how much time do you have in a day to trade? Like basically you have yeah, you got like 6 hours. This is one day is 6 hours from 5:50 to 11:50. Yeah, it's 6 hours. So in 6 hours, you have to make a trade, right? And you have to be willing to hold your trade basically, but you have to start to look at these concepts, at these -1 projections. This is really key to every market because it even works in your market, you know? Like if I just, for example, let's say we look at this type of price action. We have this, right? And we know, okay, there will be some buyers here. What we're going to do is you're going to project this area. Let's take the other flips one more time, just for completeness sake. Okay, so you know, okay, this is how I will try and test it out. You have this 50. This is your balance area now, okay? Because from this point of time, from this swing high to this swing low, you don't have any other fractals, right? You don't have any fractals here. So this is currently your balance area. Now what you look for is a break above this 50. Look what happens. We come to the one-to-one measure move, but either way, you see, okay, we test the 50 again. We don't come any lower. That's a pity though. But you wouldn't want to enter here. You wanted to enter below here. So this would be a missed opportunity. Maybe if you would place the fib differently, let's say if you would place the fib like this, even then it wouldn't even let you get a trade on. So yeah, this would be, maybe it wouldn't be a missed opportunity, you know, because you still can't trade this bottom edge because let's say you know about higher holds, lower holds. I mean, I told you all about this stuff. Like I just put the old fib back. Let's use the old fibs. It's better for the eye. And the -1 projection, of course, at the top. Where is the -1 projection? I have to turn it around. It's a pattern, you know, it's like always repeating. It's always repeating. You take the swing high, the swing low. You get your bottom, you get your top, okay? Now you just watch the price action. In here, you see prices rotating above the 50. You get some volume. Even here, look, there is some activity coming in here. And still prices above the 50, prices above the 75. You can be sure in this type of price action now, it will squeeze, and squeeze is mostly like this. This is a squeeze. This is like really aggressive, you know, because institutions, they need two things, okay? If they want to buy, they need sellers at lower prices. So they want these type of sellers, right? They want them. So they invite them to come in, they give them good prices and all this stuff. And also they need some value. So let's take a look at the value now. Let's take the Indian 10s versus the Indian 2s. Indian 10s, Indian 2s, put the value on at this bottom here. No scale, full screen. And now what I'm gonna do is, I'm gonna smoothen it out so it looks a little bit better. And what I will do is, I put an indicator on it. This is what you can do too. You put the VMA on it, the moving average weighted. You put it on, then you go to settings. You go to settings, you smoothen it out. I always, Ray showed it on the 48. So I will use the 48. I use the blue line here, and I will just put this on, okay? So this is how the day opens, okay?
What is this VMA 48?
Yeah, right. So you take the Indian 10s, right? 10-year
You
yields.
insert it in. Okay, some. Yes.
What? Again, please.
You inserted IN10Y in VMA. Okay.
Yeah. What you do is you have the normal spread. This is the curve. This is the curve of, this represents basically your economic curve, okay?
Yes.
This should be always positive with the Nifty. It always should be positive with the Nifty. So what you do is you go to these three dots. You add indicator strategy.
Yes.
Then you put the moving average weighted on it, okay? Then a new window should pop up.
48 and
then you click to settings. You put in the length, 48, for example, and the source should be the close of each tick. So this is important, the close. Then you just put the line a little bit bigger so you know this is the line you always want to look out for, because this line is forward looking, like I told you. Like, for example, you see this is where the day cuts. Now, we just go frame by frame, okay? Like this is the open. We don't know what the open is basically, so we just go now tick for tick. Price is going down, right? Look what happens now. Price is starting to uptick, right?
yes.
So what are you thinking just by looking at the line?
Going up.
Yeah, you want to buy it.
Yes.
Let's see what happens. We just go tick by tick. And look.
Yes.
Look what happens. You see, it flattens out. So once it flattens out, right, you want to take some partials because you don't know what the next direction will be. And now look what happens. Let's see. The price is basically flat. This is where it crashes, basically. This is coming into the new day. And now look. The curve is opening down, sharply down. We get what? We get an seller's auction into an high. On divergence, you want to sell this top here somehow. I don't know how, but you need to somehow sell this uptick, maybe on a 50 pullback. Let's see. Great. You remember this bar, right? This is the order book sweep. I hope you do, because this is an important bar. It just shows you, it sweeps the high and the low of the previous candle.
Yes.
Important bar. So we go further. Boom. Next candle, next candle, next candle, next candle. We get one more squeeze. Why do we get the squeeze? Look at the value. The value is again popping up to the upside. So basically, if you would enter here, you would probably get a loss because this is right where the tick chart is just switching off. You see, it just switches from a flattener to a steepener basically. So at this point, there is no sell trade anymore. And this is basically the day. So you would have looked at this bottom here somehow. You would start to hunt for longs. In either way, at some point at this order block, maybe, you don't have to neglect the order blocks because they also work. So you try to get into the price. And if you now take the 50 here, for example, now let's say you take, yeah, this is also a P shape, by the way. If I just, wait, I need to rotate this here. Where's the -1 projection? I take the -1 projection. Because this was a bottom, this can be a longer accumulation, so you always have to look at the big picture. You can't say day by day, but man, you see, you know what I mean? Like, check this out. What is this shit? Come on. Like,
Yes, I know. This is like always project your against. I mean, if you are thinking like market is going up, then sellers high and low will be your target minus money.
yeah, it needs to go there because these people here who sold initially, they would say, I won't sell this price again. I would sell at a measured move. And look what they do. They sell at a measured move. And look, it even works. It's the same day, basically. So into the close, you sell it. But what happens is you have a type of break, right? Because this is now a break. If you take this 50 here, you get a break. You don't get a retest. You get a retest of this high here. You get like a fair price, basically. This is now balancing out the market. Like this is now, let me take this here off, basically. If you take this high here, this high here, and this low here, this is the 50, right? And you know what we do with 50s. You know what we do with 50s. Yeah, we buy the 50s, especially if values in our favor. So look how this 50 is holding. This 50 is holding pretty good. At the open, maybe you can't trade the open. I don't know if you can, but on the 1 minute, I hope we can go to the 1 minute. Yeah, we can. Prices opening down, taking out the stop here. Big volume coming up, retest here on this large candle. Basically, like if you remember what I told you about, this is now becoming a zone. I mean, you marked this out and you had a pretty good analysis on this pair. I think it was okay. It was even this exactly this day because price came back to this level. Not quite sure. Have to see. Yeah, you marked this here out, right? Yes, this is what you marked out. This is exactly what you marked out. And look what happens here again. Boom. Price is going up, making a higher high. Successful auction. Goes sideways. So you see, this was a 50. This was today's market, basically, this expansion from this bottom here. But you also see if you take this swing high, this swing low. Was it this swing high, this swing low? Man, I'm not sure. I think it was, but I'm not sure. Was it this here? This swing high, this swing low? Nah, wait. Maybe it was an even different price action. Was it this bottom we projected? Ah, yeah, we did it like, no, we didn't. Ah, what did I do wrong? Something. I'm not even sure if it was the same price as before. I'm not sure now. If we got a projection on this year. I don't even know.
You are saying that every reversal must be a projection of somewhat of some -1. Every reversal.
Yeah, I just don't know because we previously had something marked up and it showed us clearly the -1, but I think it was previously. It wasn't really this day. It was another day. I just have taken this. I've mistaken it. But either way, you can pull your fib from here to here. Like, wait, I need to put all my levels on again. I'm getting confused now. This is the 1, this is the 0, where is the -1? Yeah, here, okay. Basically, if you take this here, this is approximately, it's not always perfect. Like I said, it's always a range. So you always have to think in terms of ranges, but let's take this low and this high here. You get the shape. You get the shape of the market basically, because what you do get is the first test of the 75 area, right? This is an area. Then you come back up, look, we rejected, right? This is now buyers coming into the market. Buyers here.
Yes.
And basically buyers here. So you have a seller, two buyers here previously, and look what the buyers are trying to do. Price is really slow, and now the 50 is coming in, the 50 sells off here. Price is just testing the 25 now, chilling here, and this is where you don't want to buy below old lows, because look what happens, it holds, right? It holds below this level. It's not giving any sign of strong volume or anything, so people would like to buy it, but they're just front running the price. So what happens is they get one more stop run, and then they go in the final direction basically. So you could say, okay, you know what? It's not the -1 projection, it's maybe the -1, the -0.5, it's even the -2. Okay, it's the -2 projection here. So you see these projections are just helping tools basically. So they just help you out in your analysis. All right, bro, look, this is what I wanted to cover too, Indian rupee. You said you can trade the US dollar Indian rupee, right?
Yes, I can.
Okay, cool. Maybe you don't want to, but I'm just showing you how you can do it. So the US is the first currency pair. So you take the US 10-year minus the Indian 10 years. And this is the curve spread basically. US 10-year minus Indian 10-year. Right. So this in nature should follow price. So this line here should wait. Let's put everything off so we don't see anything. So we can't cheat. I don't want to cheat on this, you know. I just want to show you that it has to follow some type of yield. We take the 30-minute chart, and now we just have, you see, it's also really strong affected with the US 10s minus the 2s, because it mainly weights on the US dollars. So from this high, right, to this low, this is just a curve. What do you think you should be doing in this price movement? Selling, right?
Yes.
Like this, where is it? Here, it was here. It was this day basically. So you want to sell into fresh liquidity highs. Like, for example, this is now liquidity. I have to take fractals on. This takes out liquidity. This, and boom, once you see this curve is already front running and you see this high price, you see there are even order blocks here, like you can trade this. You can trade this. And also if you just take a projection from high to low, you get some type of projection. You always get any projection, you know. So you get the -5 level, you get the order block here. You can try to sell it. If you don't want to sell it, guess what? What you can do is, I don't know how many pips this even is. I don't know if it's a lot or not, but like, let's say you aim for these lows here, okay? You want to take out these lows here. It never takes out these lows, or at some point it does here. Barely. I wouldn't consider it taking out the low, but you see the curve is basically down, right?
Yes.
So I swear, man. So basically all you want to do is sell it. You don't look at any buys from the bottom. You look at the buys from the bottom when the value is in your direction. So you can take this 50 entry here. It's even below the 50. If you take the swing low, the swing high here, again, you got your 25, your 50 level. The curve is dropping, and it's dropping with price. You see? It's just a repeating pattern. And look, you got your -1 projection here. Eventually it gets hit the next day, like here. And you take the trade off and it rejects, right? It comes back to your entry. And this is just consolidation, okay? But I need something to trend. I need some trending stuff. Like here, for example. Look what happens here on the curve. Basically this day here, I maybe need a 15-minute time frame because this looks really messy. Let's take the, not the 8th, but let's take the 9th, the 1st, the 2nd. Wow, now I did some mad stuff. Okay, in this example, this is really tough to see. Wait, I know what I did. I did some wrong shit, man. I did the wrong curve equation. Okay, I'm sorry. It's not the EN, it's the EN tens. It's not the twos. It's not the twos. It's the tens. The US tens minus the EN tens. I don't know how I missed that. Okay. I already thought, why is it looking so weird? Okay, you see it's clearer now. It's a little bit clearer now. Look, for this example, right? Let's take this opening, for example, and the curve is down, okay? What we can do is we can also do the same stuff here. You can apply the same stuff here. You can add indicator strategy, moving average weighted, take the close of it, put the style a little bit thicker so you can see it actually, and you flatten it out with a 48 EMA. So what you know is what you basically see. So already you have some type of top in the curve here. You will always have this type of, like, if you just watch the curve, you see it starts to top out because this is decreasing, right? I have to put this here off. You see this line is going down.
Yeah.
So you're not longer looking for any buys. You don't look for any buys. You look to sell the higher highs, basically. So, for example, this makes a higher high right here. This is a big fit. This is a half level, basically. This is a 35, 73, 50 level. So you would look out for this type of level and look what happens. It never comes here. This is kind of funny, but you see it makes higher highs. It makes high highs while the curve is going down. So on the next day, you would say, okay, you look for short side business, okay? You look only for short side at liquidity. Look what you get. Okay, perfect. You see a pin bar, a big level. You see it on the down tick. The curve is still down. So you just look to sell it. Okay, let's say you sell it here. It stops you out. It comes higher. At some point, you will fade the levels, but that's not what I want to teach you. I basically want to teach you, okay, what the fuck? Basically, you should be still selling it, but
This is not possible.
this is just madness, man. I'm telling you.
That's
Basically,
why
you should be selling when the curve is flattening out, not when it's steepening, you should buy it. But in this example, maybe there is always some fundamental news, maybe because of, if you take the US 10s, even the US 10s are dropping. So you see, you eventually get the drop at some point, but it's just doesn't make any sense to sell it because you want to sell it above a big 50 and now it's coming to the 80s, 90s. Like it's going way, this is acceleration because the market makers, you always have to think about the market makers going short into, this is basically a withdrawal of liquidity on a higher time frame. If you think about it like this, because the market maker needs to sell these candles. He needs to sell these candles. So at some point, he will just close off the top with a very large candle, probably on higher volume. It's not even high volume. Can't even think about this. But at some point, he will have to cap the top out and he will start to buy on the other side, basically. So this is where the market maker starts to buy on the red candles. Like, this is just balancing out, he has to balance out the book at some point. So if this is all buy side, it will have to go sell side at some point. The thing is, we just have to identify where it is. With the curve, I have to agree, man, it's kind of hard. So I wouldn't even look at this curve. I would just look at the Indian 2s versus the 10s, basically. So this gives maybe a clearer picture. Like, if you see, but nah, not, yeah, you could. Because you have to, I don't know if there's an Indian rupee futures. I don't think there is. Actually, there isn't. No. Nope. But if there would be, how can I say, a futures contract for the rupee, you could see it, because I will show it on the euro. For example, just you take the euro futures, and I just show it so you know this line is like the economic line for the country, basically. So I take the DE10s minus the 2s, and this should follow price. This should be positively correlated to price. So basically I click on auto. Let's take a higher time frame. Let's take a 1 hour maybe. You see, this is basically just
Why this is diverging?
what?
Divergence at the end. What is
Yeah,
the
there
meaning?
is divergence, but over you want to trade in the basically in the, how can I say, in the direction of the line, you know, like this, for example, this is pretty obvious. Like at this point, for example, you see price is rallying hard to the upside from this point, right? It's not even dropping, and this is taking out liquidity. So this is a no-brainer buy, you know, this candle here, because you know value is way up higher. You get a pin bar on a liquidity, on this liquidity here. You get liquidity, pin bar on higher value, and this is the divergence. This is the divergence I'm talking about. In your market, it's kind of harder to spot, I'm honest, man, but look, this curve here is going up, right? This is way higher than this candle. This curve doesn't make a lower low. So at this point, you just simply buy it. You buy it, and look what happens. Even here, the curve is still way higher, even when price is dropping off. The price is flat. The curve is dropping here. So you wouldn't look for any buys at this moment. So at this moment, like from this overnight session, you would look to sell it here. And you would maybe get some
I
type of
cannot
sell.
take this yield thing. This is
Yeah,
not.
it's hard to spot, I'm honest, man, but you always have to think about it like this. Wait, I will just mark it out. So I just want you to understand the basic concept of the yield. Just the basic concept. Basically, if this is price and this is yield, right? This is yield and this is price. You want to sell the price so it comes down. The best example is basically the USD JPY. Like I know you can't trade it, but I will just show it to you so you know that it makes far more sense. And you take the US 10-year. So in either direction, this line, this has a positive correlation. You see it? Like,
Yes.
and this is where you can spot divergence. Like, for example, let's see if we get any divergence here. Like here, this is the perfect example for some divergence. Price is fairly low, okay? You get this drop off, but you don't get any drop off in the curve, basically. So from this point here, this is a divergence. Like this is also perfect divergence at the top edge, because look, this is price. Price is not making any higher highs. And from here, you already know, okay, the next liquidity run, this is a withdrawal of liquidity, basically. If you see it, big up candle on a high price. You see it, it drops down. One more retest on low volume, lower volume than previously. Big red candle, boom, it's selling off. So if I can even take the daily, you will even see divergence on the daily. Like, look at this. Wait, I click on auto. You basically see when you start to sell. Do you see the sell program coming in? Like, price is pretty correlated here. Comes up, and now look at this big divergence. This is like huge divergence at this top edge. Do you see the yield making any higher high at this point? Look,
No,
the yield curve is way down, so you want to sell this as much as possible. And this is what the yield curve is really about, because it predicts a lot. Like it also predicted like the crash of 2019, you know, 20. I mean, like, look, it was already declining here, right? So you see, this is just a big withdrawal of liquidity, like
Yes.
big candle, and suddenly, boom, 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 it just goes straight for a couple of days. And the curve is just following, you know, the curve is dropping at this point. So you want to start selling this high here, you sell this high here, you want to sell this high here, and at some point you don't start to sell this, but this is like where you really want to start, because you see this is on an uptick, this candle is on an uptick, this is basically on an uptick downtick, this is all fine, right? But at this present moment, this is not fine anymore, because this is obviously a huge candle and something is happening. Something is happening. You get a retest of the 50 basically. If you just take swing high, swing low on the 75, I'm sorry, man, not the, on the 75. If you take the swing low, the swing high, you get your 75 level tested, your 25 level tested, then it chills below the 25, and then it just goes for a measured move of -2. You jump out the move here, man, and you know there is a buy coming in, because why? Value is starting to kick up. But in this moment, right, you see it, price is just following the curve. And at this present moment where the pin bar comes, this is where the value switches on. So, you know, from this time being, like, look, it doesn't make any lower low at this point. So even here, again, you start to see selling, right? You can even sell these pin bars, these tops, basically. You sell this here, the next day it comes up, you sell this here. Maybe you're not successful on these days, right? But one day you will hit it, and you will get 1, 2, 3, 4, 5 candles of selling until the value is starting to kick up again in this particular moment. So once this curve is going back up again, you don't look for sells anymore. Again, here, curve is down, you start to look for sells, especially on up candles. You always want to sell into up candles. So when you see this is ticking down, this is ticking up, you just try to sell it, boom, it goes. Just the same as when prices, for example, like this here. Okay, this is basically pretty steep.
If you see Band Nifty and my curve, so can you predict what it is saying?
Yeah, it should be the same if you take the Indian 10-year without even the spread. If you don't even have to use the spread, you can just use the Indian 10 years, for example. Let's take a look. I will have to take volume on of Indian 10-year. It's not as accurate, I would say, but overall in the big picture. Now wait. This is like, let's take a weekly first. Let's break it down from the weekly. You see, like, okay, there was no real divergence. Of course, at this point here, at this present time, there is, of course, divergence. You see that this is dropping off, this is rising higher. So you don't look to buy anything here. Just the same as here. On this up bar, you want to look to sell it. On this up bar, you want to look to sell it because the value is way lower. And you would start to look to buy at red bars, basically when value is upticking. So when it's red, imagine this, you buy the close, okay? Imagine you buy the close of the candle when the line is ticking up. You buy at the weekly close and look what happens. Boom, goes up. Here, no trade because the value is dropping and the close. So you can't do anything. But here, same thing. You sell the close, okay, you might get stopped out. You sell the close, you might get stopped out. You sell the close at some point. Well, okay. This is like bad example, to be honest. This here drops at some point, okay, here, like boom, drops here once, drops twice, but it holds. It's a higher hold at this present moment. You don't want to sell it. It doesn't make any sense because if you take, where's the zero level here? If you take it, this is just a higher hold. It comes up like this is, you can even use the concept we applied from previously, like you take the 76, you take the 61, the 5, you put all the stuff off for a second. You wait for it to break the 50 here, you wait for the 50, you see the retest, and you get your -1 deviation. You even get your, if I put the -1 on it, this is too much. Wait, let me get the -5 on it. The -5, the 75 at some point. You see, it's just about projections. It's just what do they have in store. Like if I take the swing high, the swing low, put the -1 on it. If somebody would be a buyer from here, I have to change up these levels here again. Oh man, wait, I'm gonna take a zip, man.
That's okay.
Man, okay, we're already 1 hour in. Like yeah, this is a balance area, right? Then you got the curve, and you see the curve is not really improving at all. So you have to experiment with the curve. Like I like to take the spread of the curve because this is the front end and this is the back end. Okay, so the back end is always deflationary and the front end is inflationary. But you see from this time, now it makes sense. Now it makes bigger sense to buy it, because if the 10s are going higher than the 2s, basically, because you always have to think about it like this. Wait, whiteboard. I need my whiteboard. I can show it on the whiteboard. This is probably way better. I will just show you the function of a curve, basically, the yield curve. I do have it somewhere on my papers, somewhere written on my papers. Just can't find it right now. Do I find it? Do I find it? I won't find it. Okay. 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 Cool. 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 Ah, yeah. Okay. Okay. But I get the concept. Okay. So black. You got the time, right? This is like you get this curve. This is maturity. Like for example, take the 2s. This is the 5s. This is the 10s, and this is the 30s. Okay.
Yes.
And we take a different. This is percentage and yield. Okay. Understand this? So if you buy a 2-year maturity, like, well, wait, hold on. Like, I'm sorry. I would take, this is time. This is percentage yield. Okay. And we get like 0, we got 1, 2, 3, and we make 4 of it. So we take the blue one. If you buy the 2-year maturity, you won't get as much yield as if you buy the 30-year maturity. So in nature, this curve looks like this. We start from the 2, and the 2s is like this. If you buy the 5-year maturity yield, right, you get more yield because you're holding for a longer time. Okay.
Yeah.
So the longer you hold, the more yield you get. So this just means that the investors are more optimistic about the future. And for the 30-year, of course, you would just get the max percentage. So you see, this is the 30s, this is the 10s, this is the 5s, and this is the 2s, basically. So the 2s are the slow movers. And when you take the 10s minus the 2s, this just means you're betting that the economy is good versus the economy is bad. So basically, when this goes down, this is bad, this is good. Okay?
Okay.
So in this point, if you take it like this is good for economy, and this is bad for the economy, because it's always about the yields. Yields are nothing else than basically it's just debt. It's just debt. Basically, some people buy debt, they provide liquidity to the markets. And yeah, you see, just from this time point on, like if I just put it like this, this is just hugely bullish in this present moment, right? So you just look to buy these and look at the phases, like this phase here, right? Once this accelerates up, look what price is doing. Price is basically again following. You get this order book sweep on daily, by the way. It sweeps high and low of previous candle, then test it. If you take this candle, swing high, swing low, you get a 50, approximately 50, not perfect, but approximately. And you see, it's just following the yield. It's just following it. Once it just comes to a logical level, like the 50, for example, here. You see, you get a 50 bounce on a bigger scale. Like this is a 50 bounce. And look what happens from the 50 bounce. Price is not making, the yield curve is not making any lower low, right?
Yes.
So it comes up, it comes up, it comes up. The curve is still going up on the higher time frame. It's still
In this area, I have no opportunity to sell this.
what?
In this fall, I have no opportunity to sell.
Yeah,
Or-
you just don't look at sales because of the situation. Basically, you just look. Okay, the curve is making higher highs. What is the curve predicting? Like you can sell it, but it's really just a bull market. Like for example, you can start to sell into these. Like this here, this is sellable. This is also sellable, but like for what? For a couple of days. You see, like this is your sell opportunity basically. And then once the line is kicking back up again, you rather look to buy at the lows of liquidity, because look what happens here, right? This is a low, this is printing higher, this is printing even higher, and you get a liquidity run here.
Yes.
You get a liquidity run, you say, hey, you know what? This is yield divergence, man, I can buy this. And look what happens. You can even take now your fractals on. I will just put the fractals on so we see the top and bottom fractals and the volume. You see volume is even declining into this low here. This low is higher, but from this day, this day, this day, this is basically a seller's auction already. This starts as a seller's auction because price is dropping, volume is not increasing. Then you get some type of stopping volume. You get this fractal plus a stop run. It's perfect. Then you take your swing low, swing high projection like this. Okay, you won't get anything really done here, but the -2 projection, you know where to take profits at least, like, you know, okay, I take profits here, boom, because this is just trending now. You see, this is just from this curve here, this is just no trending. You can't sell any of this momentum. What you can do is slowly, once this curve doesn't improve anymore, like this here, for example, this curve goes down, this candle is down already, but look what happens at the same present moment, right? Like this is going down and it comes back up, right? So at this point of time, in this candle here, once the yield is high, you took out all this liquidity, not this liquidity, but this liquidity. It closes like this. This is already very bullish close because you always have to think, what is the market maker doing in this big bar? He's buying it. The market maker's model is built around this. He sells into buy candles, okay? So you think he's selling, he's buying here. He's selling this candle, he's selling this candle, he's buying this candle here. It may sound stupid, right? You think, why is he buying this candle? This doesn't make any sense. But he's again selling the blue, the green candle, and he's buying the red candles, and he's buying this candle, and he starts to sell this candle. And now look what the profile is basically doing. We have 1, 2, 3, 4, 5. Yeah, 5 candles, okay? 5 times sell, and we have 1, 2, 3, 4 buys, okay?
Yeah.
5 minus 4 is what?
Good.
1. So the market is +1 short. He's 1 short. Look what happens. Price is going short. So effectively, he made money even though he has, let's say he just sold 1 lot at the highs, okay?
Yes.
He just got +1 short on the trade. And now look what happens. The market maker is again selling, 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 selling. Okay, so we know, okay, he still got the 4 buys, right? He still got the buys from here. So effectively, he can now just spread it. This is the hedge. This is the hedge he's doing now. These are all in profits, right? Because this is the last time he sold it. This is the last time he bought it, basically. This is what he bought. No, this is the last time that he bought. This price here. This is what he bought. So effectively, these positions are all in profit now. You see that?
Yeah.
But now look what happens. From this point on, he's heavy short again. Look what happens. Price is going down, price is going up and down, okay? Again, he starts to buy this candle. He likes to buy this candle. This candle. He sells this candle here. And again, he's buying this candle, right? So At some point, he just accumulated a whole lot of buys at this support and resistance, even though the yield is dropping. It doesn't matter too much, at least, because he's still making profit. And at some point, you see how price is dropping back to all this level here, basically, just to go back up again. Because think of this again. He's buying it, right? He's buying it here. He's buying it here. He's buying it here. And he's buying it here. At some point, he needs to balance out this book. So at some point, he will start to sell again, right? He's selling as the price goes up and buys as the price goes down. So he's always making some type of profit. Like he's accumulating all these red candles. He's buying this here, all this red candle. He's buying all this stuff here. All these red candles you see, he's buying it. And look what happens. The market maker is neutral. He's always neutral because he's just providing liquidity. But you see how the market maker makes this money. He's basically selling on upticks and buying. He's basically selling on upticks and buying on downticks. He's always getting the close of the candle because he's providing liquidity. The curve doesn't really matter at this point. I mean, I just wanted to test something out. I just wanted to put the moving average on it and weighted moving average on it in the 48 and 49, whatever. It doesn't really matter. And put it a little bit thicker. Oh, this I can turn this off. So this is just a whole bunch of mess, but you see how price is dropping and the price is rallying. And you always have to think about, okay, at some point, right, the market maker needs to balance out his book. If he doesn't do this, he's screwed because he will just lose money if price is continuously going up. He can't provide unlimited sales, you know? So in this whole move, imagine he's selling. Wait, I will just do it. Otherwise, I will just do it with like highlighter. Selling. I need a different color, man. This color is kind of making me mad. I'm taking the black one. And I need some more light on it, like this, okay. So what he's doing, he's selling it, selling it, selling it, selling, 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 selling. He got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 cells into the top, okay? He got 10 cells. How much buys do he have? 1, 2, 3, 4, 5, 6, 7, 8, 9. Let's say 11 cells, 12 cells, 10 buys. Okay, wait, this is getting too complicated, We just look at the top. Okay? We just look at this top edge here. Let's say you just jump into here. You see this liquidity getting out and you think to yourself, okay, what is the market maker here from this point? We got 1 cell, 3 buys, 2 cells, 3 cells, 4 cells. Okay, we got 4 cells and we got 1, 2, 3, 4, 5, 6 buys, 6 buys. So basically it's 2 plus 2 buys. It has to be 2 plus buys. But okay, we see this here, we have to count this here, and otherwise it wouldn't make any sense. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 cells. And from this move here, we got 1, 2, 3, 4, 5, 6 buys. 6 buys. So we have effectively 4 shorts left. So the market maker has 4 short, and look what happens. The prices at some point gotta go down, and it's rebalancing out all this book. So every time he sells the close, right? He sells the close. He sells the close on this one. He sells even the close on this candle here. So you see, he's making a lot of profit because he's selling into this move and buying into this move. So he's always like hedging. It's always a hedge pattern. It's always when it goes up, I would delete it. When it goes up, he's selling. When it goes down, he's buying it. So you just have to identify, is he more inclined to sell or more inclined to buy? Because if this is fast, this is the true direction of the market, right? Because this is the withdrawal of liquidity. He says, like, somebody steps in and says, I want to buy. He says, no, you don't get this price. You will get this price here at the top, because he don't want you on the books. This is why the candles are so fast. But if he wants a lot of short side business, then he knows, okay, I will just drag price really slow down, because if he takes price lower down, he has more time to accumulate his positions and also distribute his positions. Right? So what you can see in the last previous bar, basically, this is your order block. This is also like what? So almost the 75 level. But you see, you now anticipated a range. You got a range, right?
Yes.
And from this whole curve is just going down. So once you see this, you just want to sell. You sell it, you sell it, you sell it, you sell it, you sell it. Now you see it fails to break the low. This is an indication of what you say, okay, this is a failed auction on a higher time frame. So you see, this is where the curve starts to change here. So now from this time on, you just look to buy the market basically, and look what you get here on a rising yield curve. You get a liquidity run here into this low. And from this point, you get to 50, you get to 25. 25 is also an order block here. So you can mark this here out. You can just delete this. And now you just hunt longs. You always hunt longs on the down candles. Okay. Like for example, you buy this down candle, you get in profits. I wouldn't say you buy this candle, but you would get profits here. Doesn't matter. You don't want to buy the highest high. This doesn't make any sense. You want to buy at the lows. Then you get somewhat of the 50 bounce. What?
You told me some time back in message that when a sudden green move occur, there is a liquidity at high and low.
Yeah, of course, there's always liquidity below lows and highs, basically. So between these 2 points, there is always liquidity, but let's just take this structure here, okay? For example, you get the swing low, swing high.
Yes.
This is the swing low, this is the swing high. The market is failing to take out this low here, and it moves aggressively up.
Yes.
It moves aggressively up, not here, but 2 stumpy little candles. Price is declining right from this candle here, from this high to this low here. These 3 days are basically just a buyer's auction.
Yes.
This year. And we were above the 50. If you take the swing low, the swing high, this is just the 25 level basically. So, you know, these sellers didn't make any money. These sellers didn't make any money. These sellers didn't make any money. So what is the most likely explanation with a rising yield? To squeeze the highs. And once you get the high squeezed, you just look to exit the trade basically. So where do you want to exit your trade? Approximately here at -1. Does it come to -1? Eventually at some point, yeah, here. And you see, it sells off basically. This is now from today basically, because we just identified a balance area, previous balance area, right? Like, hold on. Like this swing high, this swing low, -1 projection. We get to this top here, which we currently trade in. So you know, okay, there will be profit taking, and this is where you can look basically for short-sighted business, because yeah, this is basically the top. And now if we look what the yield curve is doing, like the yield curve is already dropping off, right? You see it? This is like from this time on, like from here, it's not making any higher highs here from this point. So you would be inclined to sell all the higher highs here. Withdraw of liquidity into the highs, chilling, boom, dropping off. Dropping off, dropping off. Look what happens. Price is dropping off here aggressively. Price is going, yield is going up, price is dropping. Yield is eventually following. It's not always that the price is following the curve, but sometimes the curve is just lagging behind, especially for your market, I think. I'm not sure, but sometimes you see this drop off here. Like once you see this drop off here, you know, okay, the market will probably withdraw liquidity to this level, and you see it just does exactly this. It does exactly what it should do. Like from this day, it cracks down, and you got now your 50 area, your -1 projection. You know, okay, this is where I want to look for buys or for exits, basically. You see?
So if I
Like,
think if yield
and
is
this is not perfect divergence. Look. Just 1 second, okay? This is what I mean by divergence. Now you have a rising yield, right? And a low price. At a projection you already marked out from your day. Like you took this here, you can even take this here. It doesn't really matter. It doesn't matter which low, which high you take. Like you have this here on your chart, right?
yes.
You see that the curve is basically following price. It's dropping, and from this time on, it's aggressively dropping. So you're at the 50 now. You see this type of stuff. You see this order book sweep here. It takes out this liquidity. It takes out this liquidity. This is your basically the best bar you can get in a trade.
Order book
And
sweep.
yeah, it's the order book sweep. You see, and your stop loss is just above this candle here. And now you see we get the 25 hold. This is basically the price action from previously, which we had on. And if I just click auto now, you see price is dropping quite hardly because this price level, this measured move was already priced in. The yield priced it in. But now at this moment, just look where the yield is and where price is. This is now the best confirmation you have because you have a big discount at a measured level. And you can be sure you can squeeze. You just can't buy this pin bar because pin bars are absorption. Somebody is absorbing all the selling because they need to accumulate size. And look, at some point, you just get back to this 50 here. You just get eventually, if you take this swing high, this swing low, you get a bigger balance area now. And you can just say, okay, you know what? I can look for 50 entries. This is now a B shape. If you see what I mean, like the yield is kicking off, but it closed relatively flat. If you take it like this, this is relatively flat, okay? But this was a divergence basically at this point here. Like this was huge divergence with price because this price here was a premium and this price here was a discount basically. You see it?
Yes.
So there was some mispricing. They fixed the mispricing by letting the price drop and then just buying it back. So they created the range, and now what we have is a B shape, a P shape. The P shape is just boom this here. We have some value in between this point and this point and this point. There is no real value at this stage here, you see? So this is low liquidity basically. Every time it holds above the 50 here, it holds above the 50 here. So what you can expect is if you see this here, boom, boom, you can just think, okay, price will go for a one-to-one measure. Because if yields was dropping, the yields are still dropping, but now it's kind of flat, right? So you would say, okay, we can probably squeeze the high and go for a one-to-one measure. So you mark out the measure move like this. Mark out the measure move. Where is it? Here. You put you look if there's any round levels in between. Not really. Maybe it's an option level. I'm not sure. We can take a look at this too, but now I will just mark this off here. But you see how this is what the yield curve is basically for, to identify discounts or premiums.
Can you see on 7 when there is a squeeze upon this and yield is down, so I should leave this trade.
Explain that again.
On 7, when you see the yield is down sharply.
Yeah, here.
And price is going up sharply.
Yeah.
So what I should do at this time?
You got a premium on the curve, okay? So when you have a premium on the curve, you usually look for buys on the price. So at this point, this is big divergence what you have here, because even if this here drops, right, and this here rises, you still need fair value, at least fair value. So either way, you can buy the price. Either way, it has to retrace because it comes from a measured move, you know, like if it comes from here, there is why would somebody not try to buy this price if it's cheaper than previously? If it's 100% cheaper than previously, why would somebody not buy the price? You know,
Okay.
there always will be a buyer, except if the curve is down. Like there are some instances, like here's a sharp move in the curve, basically. Like this curve is still up, right? Like at this point, this curve is very, I think we already had this once analyzed, I'm not sure, but you see, the curve opens, the price is dropping. The price is taking out liquidity, like this liquidity here. It's taking out the liquidity and it's rejecting on pin bars. Now look, this is now a big discount. This is your discount. You say, hey, we get liquidity and we get a big yield divergence. I can try to look and buy. And look what happens. Eventually, this collapses completely down, but it pops up. So once it pops up and you don't see price coming back, you just hold on to the trade because, yeah, the trade eventually goes in your direction. You see, you get a big down spike here, but the curve is, this is where you look to exit your trade basically, because we don't make any higher highs, price is making higher highs. And eventually you see a sharp decline here. You see it? Decline,
Yes.
price is dropping. You see here the bounce, right? This is like, you see here a bounce in the yield curve. It's aggressively popping up. So you look for liquidity. Where is liquidity? Well, liquidity is here. So let's say we get this liquidity. Do we get it? Do we get it? Do we get it? Do we get liquidity? Come on, come on, come on, come on. Give me this liquidity. Yeah, basically you get this liquidity at this point here. So you would sit out all this mess, right? But you see, this is now slowly declining. But we get this liquidity here on the pin bar. So we can say, okay, you know what? This is buyable at least. This is something, you see how the spread here popped up? This is somewhat of, you can buy it. It's not as strong. You always have to measure it. Is it strong divergence or is it minor divergence? Because the yield isn't doing any higher highs at this point, right? It didn't make any higher high yet from this point. So you would be actually careful, but once it takes out this liquidity low here on the pin bar and it comes back up like this aggressively, you just have your Fibonacci, you take it from swing high to swing low. You can even take it out. Look, it fades the level again and it doesn't take out the high, but now look what happens with the yield. This is not a perfect example.
Yield is
You get a higher yield and a lower price, right?
Yes.
This is obviously when you want to buy it, because now it goes, and it doesn't really squeeze this high here again. It's rejecting the 75 level and the yield is just dropping off from this moment. So you say, okay, you know what? This was a decent trade. You can take profits or just letting something run. Eventually, look what happens. Price is dropping off, yield curve is improving, price is making higher highs. And at some point, we get this liquidity here at the top. And look what happens when we get the liquidity. We get liquidity, prices, the yields is slowly dropping off now. Slowly, it's not making any higher highs while price is maintaining higher highs. So this top here at the curve is like a double top, okay? And you see eventually price comes to this double top here and you know, okay, this is sellable again because the yield is declining, especially here on this chart. And look, you get some sells, again, liquidity here, you get like this liquidity bar. You sell the higher highs because look at the divergence here at this point. Okay, I can agree, it kicks up, right? But you take the biggest liquidity, basically, you take the biggest liquidity and wait for it to break above. And when it pins back down and comes like this is your sell opportunity, because then you just use your measured moves and you take your Fibonacci, you get your 50, right? You get your 50, you got the yield. Well, you see, it comes through the 0 level, but it fails to go any lower because, again, it rejects. This is basically the close of the day. But overall, you see how the curve, when it starts to tick down, the price is also ticking down. And when it ticks up, the price is also ticking up. And when it ticks down, the price is ticking up. And Like for this instance here, this is ticking down very hard, okay? You get a pullback. This is like a 50 pullback now. You get this 50 pullback from here to here. It's a little bit more than a 50 pullback, but you see at this present moment at the 50 here again. This is basically now September the 1st. You get this 50 pullback here and you see the yield is dropping off quite nicely. So you're only inclined to sell really. So you even get this order block here, right? This is pretty accurate as well. You get these pin bars, pin bars, pin bars. And at some point, you see it just dropping off. You see it dropping off. Takes out this liquidity here. And you see the yield is kicking off to the upside pretty hard here. So once you see this type of form shape here from this level, especially because this was like a support and resistance level from back here, right? Like
Okay.
no support resistance basically.
This is too much knowledge. Give me some time
Okay.
so I can just absorb this.
Yeah, okay. But overall, you see the shape of the structure. Like this was like a perfect example. If you see something like this, you see a rising yield and a dropping price, you're inclined to buy at liquidity levels basically.
Okay, I understand that. So thank you very much for this session.
No problem, man. I think I covered everything I wanted to cover. I mean, in your markets, it's very hard, man. I mean, on gold, it's a little bit easier with the yield. Like, for example, if I show you the US 10s and 2s 10s, like, no, wait, like, you know, these markets are easier to trade. Like, I can use the Euro USD, for example, to determine the direction of gold, for example. Just one quick example. You can take the Euro USD and just say, you see where where gold is moving most likely, because look, like, you see how accurate this actually is. Like, it's either gold following Euro USD or Euro USD following gold, but you see, it's almost the same. It's identical.
Yes.
Like, and this is how you also can spot divergence. Like, for example, yeah, look at this top here. This is brilliant. Like, this is a brilliant top edge here. You see, this is a big spike, right?
Yes.
Now you see this curve is not making a higher high. This is like ICT's SMT divergence.
Yes.
You see, this is not making a higher high. Look what gold is doing actually from, let's say, this previous point. It's making a higher high at this point. So, you know, okay, this price is obviously already down, so I can sell this. And even if it retests back into these highs, this is on really, really low volume, like here, for example. This is now just a perfect sell opportunity. So, and then, like, for example, let's take it. Let's go way, way, way back in time. This bottom, for example, this bottom price here. There will be always some divergence, because either on each one, like, perfect. Look. This is the Euro USD, right? The Euro USD takes the stops out. This makes a lower low. Look what gold is doing at this present time.
I think they call this structure as a paycheck.
Yeah, this is more like paycheck, because on the Euro USD, because you have like a lot of liquidity building up and you have a lower hold as well. So if you take this balance area, right, this is your swing high, this is your swing low. Let's take the gold off, and you take your 50%. You got the lower hold, you get the liquidity, but guess what? This is just a stop take. Basically, it's just a rejection. And look what happens once it takes it and comes back into this range. It just flies, man. It just flies and flies. And you take your -2 projection, like from this swing low to this swing high. -2, look what happens. Boom. Exit the trade at this high here, basically. This is your somewhat of your profit level. And it's even your profit level for gold, because gold has somewhat of the same structure. Like, it's just very clean, you know, it's just not a lot of noise. I mean, it has a lot of noise, but imagine this is a 50-minute chart and you see, okay, they failed to rotate below this low here, but EURUSD took the stop. So you can say, okay, toxic order flow, right? 75, holding above the 50, holding above the 25. This is like the BSG trades, and look how many order block entries you can get here. You can get this one here. You can get in on the stop run. It really doesn't matter. And even then, you just go for the -1. It almost hits it, not perfectly, but it just depends how you draw your fib, you know, like it's really all dependence.
I'm thinking about currency through a what you say funding program, that FTMO type.
You can do FTMO.
But if my government, I mean bank in my country, this is not allowed. So this is
Okay,
a
okay.
possibility that bank
Yeah,
does not.
this is a little bit different then.
Yeah.
You know, what's also really interesting is
But
you can trade the oil market, right? You can trade oil.
Yes, all together.
This is basically the best thing you can trade, because you know I tried to sell oil top edges because Ray called it out. Liquidity here, you know, like you get some nice sells here, but like overall, like oil and the curve, right? This curve here, look, this is like the DE10s and the US10s, basically. This is like, it should be textbook. Like this is huge divergence on the curve here. You see, this price is high, it drops off, this price drops, and this is very low, and this is actually very high. But it fails to take out this liquidity. So guess what? We go for this bottom edge liquidity. Look what happens. Curve is again popping up. Look what oil is doing. Oil is accumulating into the lows. It's just holding this level. You see, it's just holding an overall level, and at some point it just pops to the upside aggressively. You can take the DE10s, or you can even take the 10s 2s from the US, and you will see it's just basically the same curve. Like, let me get a daily picture so you can see that the daily picture. Okay, man, it's not that clear, but you can see the spikes in the bottom. You see once this ticks up, you can buy it, and once this ticks down, you can try to sell it, especially at this point here. Imagine you would sell this liquidity here, right, with a down tick. Like, where is it? Where was it? I gotta search for it. Need to find my line. Where is it? Holy crap. Here, at this top here. This is like, this is basically what we was looking at. Like you, oh no, come on, man. This is the last thing I want to show you, then I let you go, man. But you see, from the opening, basically, you just get this type of messy storyline here. And at some point, you see this curve. If you look at the curve, basically at the curve picture, the curve is not making any higher highs from this point here. So from this day, you have basically a flattener in the curve. So the price is steepening, this is flattening out. So you would be inclined to sell every higher high. And imagine you would sell this higher high and would, let's say, no, wait, hold on. We know that the curve is down, right? So you would try to sell into this high here, then it stops you out. You try to sell this high here, and even if you don't get this high here, you just sell the 50 pullback here. Like, okay, this is the 75 pullback approximately. It depends on how you pull your fib. But if you take the swing high, this low, this is your 50, right? The same concepts apply. And look, you just sell the 50 for the -2 projection. And okay, this is like crazy, but you get the picture. It's always, oil is actually very easy to trade, bro. I hope you can do some backtesting, especially with the method I've showed you, like the stupid simple Fibonacci exercise. Okay, like I will just do it one more time. Okay, do you have to go? Or
No.
Okay, like simply stupid exercise. You take the 50 here, you see it break, here, it pulls back, you sell it once, right? You sell it here. What? You get money, right?
Yes.
Cool. So it comes back higher, it fails to rotate, it pins. Now you get some order block entries. You see these 15-minute candles? These are all sellable. Pins here. Now look, until your target is reached, and look what happens. Your target is reached. Guess what happens, man? It's gone buy side. It's gone buy side again to the same zone, right? So you know, okay, I've sold this zone previously. I can sell it again. And look what happens. Boom, boom, boom. You get a -1 projection even, like here, and look what happens. Price is just instantly rallying. And look, these type of trades, like I didn't cherry pick this, I just did it because, okay, it is a top edge, but this is what you want to look out for. You want to look for top and bottom edges with this type of concept, right? Because let's go to any given day. Let's go to this day here. Let's go to this day, yeah. Let's say we await, let's take the curve. Let's take the curve on. Where's the curve? Where's the curve? I think the US 10s should be positively too, yeah. Okay. Let's take this here, for example. Wait, let me take off this curve. Let's say let's say you don't get this type of entry price here at this high, okay? Let's say this is now our balance area. This is a big balance area, by the way. This is now, once this breaks, you look for a pullback. Okay, so this here breaks, breaks. Nice. We check it. Does it come back? Yeah, it does come back. Okay, doesn't make sense because this pullback was probably way too strong. So, okay, you have to always also adapt on the time frames. Like you have to measure the 30-minute balance areas, even the 1 hour balance areas. Sometimes the 1 hour balance areas can give you a very clean trade like this, for example. This doesn't even give you a trade. This is just the bottom of the bottom. But like, for example, if you want to get in on, how do you get in on this trade? You can't get even in on this trade. You have to look at somewhat bigger, like take this whole area here, and then you just get your 50 projection. And yeah, you see, you just look to buy above the 50. And now you can see actually the buys coming in. So for example, we just go into this day here and you take the swing low and the swing high here. And once this 50 breaks, we look for projection up to here for a buy to here, and we look to buy here and here. And look what ultimately happens. Yeah, it comes down into the zone. It comes into the zone again. This is now a higher time frame chart. But still, you see, at some point, even if you buy here, let's say you buy the first test, you don't want to actually buy the first test because you want to look at, you just know, okay, we're above the 50, we broke structure to the upside, so it shouldn't make a lower low. It doesn't make sense. Price is now in consolidation, but you see, basically, you can't try to sell it because this is a 75 level. If you put the 75 on it, it's somewhere in between here. This is why it rejected. But overall, you see, you buy the red levels, right? And you get profitable, then it comes back lower. And when it comes lower, just try to fade the levels and try to get in again. Like this makes a lower low. Like for example, you see lower low, it rejects, it comes back. You apply the same stuff. This is now a 1 hour chart, and now you just go to the 5 minute. I need to
What
just.
Is this level 1, level 2 liquidity and FTR?
This is like a level 2 liquidity because look what happens. This is like a level 1. This is a level 1 because why? Price doesn't reject back into the range because this is the range, right?
Yes.
So this is just L2 liquidity because they took the stops out, but they didn't bought the stops here. They bought the stops at this point here. So when you go to the 1 minute time frame, basically this is all level 2, level 1. This is level 1, and at this point, once price comes back here, like if it takes out these stops here at this point, this is now level 2 liquidity because it failed to rotate and it's still in the same area. So what you effectively have now is this big balance area, basically from here to here. I will just make it white so we can see it. This is now our balance area, right? And we already have our sort of structure. But look, this is now really interesting what happens. You get this big volume candle, right? You can mark out the open on this candle here. Like this is huge volume. You can mark it out in time and look what happens. If it comes back, when it comes back, does it come back? Does it come back? It comes back. It comes back for this whole liquidity, to be honest. But this is a level where you look to buy it, basically. You just look to buy the round figures, you know, like if you put the round figures on, this is also very important. Look how much money you've made just by, you have a lot of, I have a lot of shit now on my chart, I have to say, but look at it, you get the 86 level, right? This is your volume level, this is your volume, this is your 50, this green line is your 50, basically your big 50, and you took stops, and you took this stop here. Wait, we identified this price level here first, but either way, we took out these stops here. So you took out, and this is paycheck, and this is basically now paycheck coming in, because we have a lot of liquidity. We push up, fail to rotate. Look, guess what happens? It goes for the stops one more time, and now they got just enough stops. Like we got massive stops. We got here one stop level, basically one stop level, two stop level, and we get ultimately this stop level here. We got 3 levels of liquidity, right? 1, 2, 3. It takes out all these levels and comes back into the range. It comes back and it accumulates. And this is what you want to see. You want to see this accumulation because now you can say, okay, you know what? This is interesting. This is consolidation. You measure your balance area, basically. I don't know how I would measure it. I probably would do it like this. Now you see, take your normal fib levels, basically, like this, like this, like this. You just take your normal Fibonacci's, or you measure moves, better to say. And now you see the shift in value, basically. You see from this high swing low, you get a bounce from the 75. You get one more stop run here from the 75, basically. But it holds above the 75 and pretty accurate. You see the reaction, boom, 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 big red candle, order book sweep. This is again your order book sweep candle. I have fractals on, but you see it, right? This green candle here.
Yes,
Sweeps
I can
it,
see.
and ultimately it goes higher. Now it holds above the 50, above the 50, above the 25. This is like the last trade you want to take.
In this trade, where to enter? When 50 above?
You have to look at value first. What is value saying? And for example, let's say you have different type of values for oil. For example, you have the contango and backwardation. This is not that important, but here, for example, if it's above the 25, right? These sellers here, they're underwater. So everybody who starts to sell here and here, they have no chance of rotating price down. So you want to enter somewhere in here, and you want to aim for the measured move of at least 1. So basically 1 becomes your measured move, right?
So I should enter at 25, not at 50.
You can enter at the 50, you can enter at the 50, but you always have to look at price action. This is just, it's not about really the 50, but it's about the pullback. If you see it's building value, again, like the P shape I told you about, like if you see, if I put on this here, right? The session volume. No, I don't have to put the session. I just take the fixed range. It's not necessary, but I will just show it to you. So wait. Yeah, click a set point. From here to, no, wait, from where to where I draw the fib? From here to here, basically. The value is here, somewhere in the middle. It has to be in the middle, somewhere around the 50. But if I drag it back to this high, right? This is a B shape. This doesn't make sense. You have to look at it at a bigger picture from daily. Overall, it's a B shape, right? So if you look at from this swing high, the swing low, this holds below the 50. Like, hold on. We have this liquidity, but overall, if you take this swing high, this swing low, you're still holding below this 50. So once we get to the 50, to the big 50, for example, like here, this is where you can look to buy it. Like, this is also a good time to buy it because it's the London Open. The London Open is at 7 o'clock, basically.
I should wait for that big 50.
Yeah, you should. You always have more than one liquidity level, but basically you have this range now, right? You have established this range, and
Yes.
this is what you want to work with because we don't take price out and we start to rally. And once we come to the 50, we want to see how it reacts to this 50, because when we see some accumulation from it, tell me, what do you see in this type of price action here?
Building orders maybe for the squeeze.
Now just look at the candles.
Order sweep. Order
don't-
sweep candles and
Order sweep. Yeah, you see the order book sweep here. So you know, okay, if this candle here is an order book sweep at the 50, it will have to go in one direction, right? And it's probably not the sell direction because we're building some value up here. So once you see, you can even enter at this retest now because you see we took out this high and this low here of this whole balance area. This is now a confirmed balance area basically. But what do we also have? We have now a 50 here, of course, and the 50 is here. And look what happens.
Yes, POC shift.
Yeah, we get the shift in POC because once this order book sweep is there, right? It holds approximately from the big 50 and the small 50. And now you got even your order block candle basically, the last retest, and then it just pops to the upside. And you just want to go for a measured move of what? -2, even higher, because yeah, just you would look to take some profits here, but look, you just took a 50 entry, right? And you identified this, then we go back to the 75, we get a little retracement, and now guess what? You can just expand your area like this. Let's say you don't see it. Let's say you don't see it. And you see we're still holding above the 50 here. So price is going slowly down. And what did I tell you previously? The market maker is buying into what?
Uptick or downtick.
Downticks, right? He's buying into downticks. So at some point, these sellers are still very, how can I say? He has to take some profit because this is all selling from the market maker, right? So he's accumulating sells, accumulating buys. The next move, guess what? Is again a buy move because we're above the 50. So as long as we're here above the 50 and above the big 50, you don't have to worry about anything but buy side until we take out this high here and this high here. Once we take out these two levels here, this is where you look to exit the trade basically, because we took out liquidity. You just entered here, you finished here, because we had a failed auction to the downside, remember, right? This was the low, we consolidated here, we failed to take the low and went above the 50. So if it's above the 50 already, right? If it is above the 50 already here, once it shows this type of toxic order flow, a slow move down, you can expect some type of liquidity getting taken out. And this is, in this case, the sellers, right? The sellers are getting squeezed. So now what we do have is like some type of accumulation because price is very slow. The buying and the selling is slow. And this is where you want to pay attention because now you can look for your, like, for these type of candles, you can mark out the open and just think, okay, this is one volume zone and this is my top area. So I have a 50 area here. And now this is what I want to trade next week. So we can trade this actually together, right? I just want to see if my prediction will be right. We're chilling below the 50 at the close. It's Friday, so I don't expect too much, but you see how we rejected this high and rejected this high here, but we didn't went lower. So we're in somewhat of an accumulation because, yeah, price is just, it's just distributing the price, right? We took out this high here and we're just short above a 70 level. So maybe we can get to the 70s, right? And then just drop off. Eventually, we will see something like this. A price already above 70 and then just boom, collapse all the way down to -2. Somewhere like this. And this would be reasonable. Why would it be reasonable? Because this would make from this swing low to this swing high would be somewhat of a pullback, of a good pullback, like a 50 pullback. Maybe it's even going to -1 here, right? To the previous area, like where we would have taken the buy, because there is an order block. You can say, okay, could be a fair price, but this is just enough to make your day, you know, like it's 1% a day.
So when it come back to 50, so can I buy it?
Yeah, you just wait and look for the price action to develop. And once you see some value building up from the 50, the game just goes again, you know, like it's consolidating. And at one point, for example, let's say the value is kicking hard to the downside, right? And price is just shifting. You always mind the structure, because at some point you see the shift in value here. And then you say, okay, you know what, this will be a squeeze trade. And then you just sell it for a measured move of -2, and then it comes here, and maybe here there will be some buying, you know, maybe this will be a buy area. This is the thing, you always have to build a picture what could happen with all the elements you got. Like, how can I say, like you look at the big picture, for example, right? Like let's take a look at the 4-hour. If you take, you always have to top it down, right? But let's say you take this swing low, this swing high here, and this swing low. This is your 50, you know, okay, well, the 50 has some significance. You see, there is some nice buying. This is the 25. So prices basically in a very, very P-like shape, could you say? Because if I draw it out from this high to this low, everything above the 50, this is like, but it's still sellable. You see, once it holds here, it will go higher. But when it's here, it's still below this POC here, right? So these are like two areas now we can watch for price, because price can take these stops out, go down here, and if it finds some buyers, then it can go up. Or if price is just continuing to go higher and is holding here, then it can just go up further. You know, it's all about auctions basically, but this is what you have to look at the market like P, for example, this is like a P, right? And
Yes.
the B would look like this. B would look like this.
Inverted.
The B would look like prices going down, and prices building value here. So it will take these stops at some point because it's building value below the 50. Every time the price is building value below the 50, it's a B shape. Above the 50, it's a P shape. And you don't need this type of fancy stuff here, like these VPSs. It doesn't even matter. I don't even have to show you, but on the daily, you can clearly see the P's and the B's basically, because obviously this is a P shape. You see it? Like if I just, I know it's,
Yes,
this is a P, yeah. This is also a P shape. This is also a P shape because it builds value higher, but this here is a B shape. You see it? Like, again, B shape. This is somewhat 50. This is, again, a P shape, B shape. You see, it's just P's and B's. Like,
Mark said that in the volume profile, when a high candle occurs, that is a supply zone.
yeah, sometimes you see, there is something called volume nodes. And for example, I will just show you, there is always some type of distribution. Let's say this here, for example, was pretty spot on. Like these red lines are always the POC of the day. And what you can do is, if you have access to this tool, right, you can just mark it out, time, and just leave it on, because if it's the POC, it will have some significance, like on Friday, for example. You see, it came to the zone here and it rejected. came to the zone, it rejected, but what market is currently doing is it's distributing. It's not an accumulation, it's more like a distribution from this buy side, from this, because this is a whole lot of imbalance, right? So overall, if you take this swing high here and this swing high and this swing low, this is a B shape, obviously, right? Because if I now take the indicator fixed range and where is it? Yeah, I just set the pinpoint here, right? This gives me a P shape. P shape is logical. So this is somewhat of distribution from all this buying here, because always remember, the market maker is selling when the market is going buy side, right? And at some point, he's buying when the market is going sell side. So think of it like this, the market maker is very bearish in this present moment. So we should be looking at higher highs and just selling higher highs. So when price comes above here, like in this area, we can look for a sell. If, of course, on the lower time frame, if we get confirmations, pin bars, auction types.
But price is above 50 and now it is at 75. So why you will sell that? Why you will not go for a squeeze?
Okay. This is the type. This is where you go for the squeeze, but you don't know how big the squeeze will be. Like, for example, if you take this here, right? This is now above the 25, above the 25 here, yeah. So you would say, okay, this will most likely squeeze price. And it can squeeze, but you don't know if it will be a big squeeze or a small squeeze. This is what you have to see, because the profile, right? The profile is always somewhat important. Yeah, this is a P shape and it could go for the buys, but I don't want to buy here. This is not where I want to buy. This is where I look to sell. Of course, you can. This is the thing. You can, of course, look to buy it, but you don't want to buy it here. You always want to buy at a discount. So when it puts back to the zone, like previously marked out to this 50, this is where you would like to buy. But at this present moment, you would look for a liquidity run, like a stop run, and then a sell to the 50. And when this 50 holds and builds value, then you can actually try and go for the buy. But I wouldn't go for the buy at the high, because it's just, you have to look at the single candle price action, you know, like, for example, this is Friday. I don't know what to interpret into this type of behavior here. I just see this is some type of distribution, because it's Friday, it's logical. You have a lot of buy side, and then some people take profits, and we don't know what's going to happen over the market. Maybe the market will open like this already, and then we just go up. We don't know. But we don't even care. Like, we just trade what we see. Yeah, like you have a narrative, for example.
So, when you start any pair, from which time frame to which time frame, like consider any time frame and give me like
look, okay, so let's break down oil together. Okay, we take 15 minutes, very short. You take the highs and the lows, right? The biggest highs and the lows. Okay. And of course you mark out your 50 level from this point. So the 50 level is approximately somewhere in here. We are at the 50 level. That's why I'm looking to actually sell it, because you see we reject the 50, the bigger 50. So what I see at the bottom is like this type of order block candle here. This is an order block candle, and we got this order block candle at this price, right? We got 2 price levels, and yeah, basically this is what I'm just looking at. You see the shift in value as well, because from this price to this low here, you see the 75 here rejected quite nicely, dropped to the 25 here at this point. So we have like this type of market structure right now, and the market structure is not really bullish. I mean, this was bullish, but when I take some,
there is a 2 liquidity levels are cleared, L1 and L2, and price come back again, and it is
this is the important thing. You always have to look what price will do above this high and price below this low, because we failed to rotate here, right? This is a fail to rotation. if we hold above the 50, I mean,
Yeah.
next week, then you can see this order block getting tagged. This is the 75 level, and you can try for a short back to the 50.
So I
You
think
can try, but once, look, this is the thing. Once it takes the 75 and holds above the 75, you just go for the squeeze. Like it's safe to say.
you are expecting paycheck, I think.
What?
That long red candle, that fat red candle goes in like down suddenly. Paycheck. This is paycheck structure, no?
Yeah, you see, this is not really paycheck at the moment, but if you on a daily, it's not paycheck. I mean, this would be paycheck. Like if I draw an arrow from this high, this would be like paycheck because you have liquidity here, here, and I have no doubt that this liquidity will get taken out, but I would like to see a retracement first, like filling this imbalance. This is imbalance, you know? Like
Yes.
if it fills this imbalance here at the 25 level here somewhere and then goes up, this would be a perfect buy. But for now, I'm just looking to sell it. And now if we don't even have to look at the 4 hour. Wait, I will just put this candle on. I like to use the daily, the 1 hour, and then the 15-minute and the 5-minute basically to break down all the charts. The 4 hour is like a little bit tricky. But yeah, like we established this range here, right? And then you can just take this 50 here, and you see this 50 is approximately also here, and this is the 75. So you just mark out all the levels which have significance, because look, this was a nice buy from the 75 now, right? Because you have swing high, swing low, you see a 75, you see another 25, 75, boom. It just plays ping pong at the moment. And yeah, this is just like this is not really anything right now. So we just have to see sellers are not in control of price. So we would have to be careful with sales. But if price comes above the 70 here and takes out this liquidity at 70, 60, 71, like this is what you mark out. You mark out your big figures too, like the 71, for example, the 70s. But mostly it's always going above these type of levels. And then you just look, this is a liquidity level. So you look for the 66, for example, here. And this is where I would be keen to buy the 66 or this 56, you know, like these are good levels to buy because these are like big liquidity levels. So you also can just, like I said, open interest, right? This is also something we covered once, I think. Open interest is the best thing you can do, and you can use open interest for oil, and for oil it is pretty easy to spot it because you always see the open interest on oil. I hope it just loads really quick. Man, we're in 2 hours. We have to quit soon, very soon, very soon. Okay, look, energy, VTE. Come on, load. Need to drink something. Okay, so this is from Friday. We always look at on the money puts and on the money calls. Basically, on the money puts are bullish and on the money calls are bearish. So we can say, wait, I get a call, 1 second. Okay, cool. Ah, you're there. Okay. You're there, right? I think you're there. Yeah, okay, you're here. Yeah, see, so the 70 level is really important. So we can go above this level basically. And then we just look for the price action. We just look for price action because they will hedge and there will be always some type of sell trade here and there will be always some type of buy trade here, right? And this is close to the daily order block. So we just look for these two levels. We look how price reacts and then we just mark out the 50s, like always the projections, the order book sweeps, the order blocks.
Yeah,
Liquidity runs, all the stuff.
this double top liquidity, that doesn't matter. You don't see this.
No, I just see it. It's paycheck, of course, paycheck, yeah. But this is like, if it takes it out in one go, right? If it just makes this move, it takes all this liquidity. And if it's a big candle, a big green candle, then I'm keen to sell it because it will induce a lot of hedgers and traders, and this is enough for 50 bounce back, right to here. And if the decision is to buy it back up, then it can just go back up and accumulate higher. But at some point, it will go down very sharply because the market maker is obviously very bullish, right? So he will need to clean his book at some point, and he will probably go to this liquidity level here and start from new. This is what I think. It's not like it's gonna happen like this. I just think this will happen. I don't know yet, but these are basically the zones I'm looking at. I'm looking at the reaction from this level, and I'm looking at the reaction from all these lines and this level especially because these are key levels.
So when it comes to order block, you will wait for 50 on that balance area.
Yeah, like other blocks are like this is now my GU chart, but you see other blocks can be at 50 sometimes, so it's not always there. But for example, if I take the swing high, the swing low, you see this is a 50, right? This is a 50, there is no other block here. So let's take this liquidity and this high here. Maybe we get something here from this 50. You see, for example, here's a break at 50. Like you can say it's a breaker.
Breaker, yes.
But for me personally, I just see it as a 50. I just see it because, okay, I have to accept this breaker because if you see, we had a response here, we went higher, we broke below it, we turned sell side. And then we went on. But from this moment, once we're below this 50, I'm just really keen on selling every up move. You see, once this happens, once we're above this level, and if we didn't take out this liquidity, you can take the last up candle, and once it rallies aggressively into it, it's sellable. It's always sellable. Like even here, for example, if you take this swing high, this swing low here, mark it out in price. Price is going below the 50, right? Coming back one more time, these three candles together are like one order block. It's at a supply zone. Right now it's at a supply zone. So I know, hey, you know what? I can sell it again. And look, it almost comes to the close perfectly. Like this is the close of the day, right? But look, these two projections, like this projection from, this is also some type of magical voodoo. Like this projection hits and these are almost equal, you see?
But the trick is finding the correct imbalance area.
What?
The trick
Yeah.
to capture the move, if you find the correct imbalance area.
Everything is a balance area. Like if I take this swing high, this swing low, guess what? I will come out with a price of -1 here, right?
Yeah.
And look what happens from this move. We establish a new balance area. So there is no real magic trick to it. It's just how you understand everything. Because look, this is like my go chart. Like this is my go chart with just supply and demand areas, right? And look what happens. like what my GC chart. Like there is no really look, it just hits the zone, right? And it's at the 8.5 handle, 18.05 handle, and it just rejects it. And from here, you just take, this is a balance area, right? You would agree with me that this is a balance area, this up top here, because price is balanced here. But look what,
Either it makes double top bottom like structure or sudden move. So that
like
is
look, you get the
problem.
high, you get the low, right? You get
Yes.
you don't get a higher high and you don't get a lower low. So it must be some type of accumulation or distribution.
Yes.
You don't see anything to trade right now because what you look for is value and the 50. So what you can do is you take your Euro chart, for example, on gold, right? And you see, okay, the Euro chart is kicking to the upside here at this point, but price is pretty high. So it should squeeze, but it doesn't, right? So you just wait, you just wait, you just wait. And at some point, it's just doing mad stuff. Like you can't trade this, but once now look, now this is where it gets interesting because the euro is now dropping and this made a higher high. This didn't make a higher high. So, you know, okay, they probably overpriced the gold and you will have to sell it and look what happens. Now you get below the 50 and look at the pin bars at the 50, right? Boom, boom, boom. And at some point, these people who bought here, they will jump out of the trade and look what happens. Boom, you get your -1 deviation. Look at the pin bar coming right in. Boom, once this goes, boom, pin bar, right?
Yes.
It drops off further, to this level here and rejects. And now you can just project a new balance area because now you have a bigger balance area. You have this type of balance area. Now you have your 50 level, you have your 50 level. You get this type of massive stop run here, okay? I wouldn't, you would probably get stopped out on this probably. I'm not sure, but either way, you get a new balance area and you just look for the fractal highs and fractal lows. Like you can even take this swing low and this swing high, right? Because you think, okay, price is bearish from this point. Because this is your supply zone. It doesn't react from this zone for nothing, you know? It didn't make this move for nothing. So once it comes back and it's coming to a next supply zone, look what happens. Price is holding below the 50, consolidation below 50, below 50. What do you think will happen next? Squeezing, squeezing, squeezing. Yes. And then like, it's always the same pattern. Like you can even identify the squeeze trade in, this is a balance area, you know? Like if you take swing high, swing low, you draw it out in time. This is your 50. It's kind of messy, I agree. But look, once this here high volume, right, at 25 level, below the 25 high volume, you see this last candle, maybe you spot some order book sweep, but the 75 here, and this is also a B shape now because, yeah, market is just a B shape. Like from, if you take this here, this high here, this is just a B shape. So once it's below this B shape here, you say, okay, this will go for the squeeze. It squeezes, it pulls back to this level, and it goes further. And you can do it on the 1 minute time frame. You can do it on every time frame you want because you can even go here, like for example, on the 1 minute time frame, and you will see the same exact type of thing, like this price action. You will even see it clearer on the 1 minute because you see the pin rejections, like 75, 75, it drops off, 50, 25, comes below the zero, comes back, it holds below this line. And once it holds, it's type of a flippy zone. Like, look, it comes back to exactly the same level right here. Yes. And just continues to sell off. And this is now your new balance area, basically.
That is total 50. That is if range expanded 50.
Yeah, but now you get exactly the same. You get a price rally, you get your zeros, you get your zero. Let's say this is just a stop run. You get your 50 prices again below 50, coming to zero, coming again here, holding below 25. It's not much, you know, it's not much in terms of pips, but it's like it's 20 pips. It's 20 pips. I mean, it's not bad. And then you see, it's just a repeating pattern. You can, on oil, it's even clearer. Like you see this pattern all over. Like, for example, okay, not on this day, but let's just try to get on next week. Okay, man, maybe we can find something live in the room, like on oil, because the oil
Okay.
open, I mean, the oil open is usually around 15:30 my time. I don't know what this is. If I wait
15:30, yeah, it
15:30,
means
this is, wait, look, I just mark it out so I can tell you what time it is at your point. It is, you're in +5, right?
yes,
What is
plus
it?
5:30 to Kolkata, plus 5:30.
Kolkata.
Yeah.
It's 19 o'clock in your time, basically, so it's evening. So you can even
Okay.
trade in the evening for like, maybe you can trade. I don't know if you can, but you see around this time here at your time, right? This is probably something you never really realized. Maybe you did, I don't know, but look at the time. Look what happens most of the time. There is always something coming, right? Like some big moves,
Yeah.
like again, here 19, 19, 19, where's the 19 handle? The 19 handle is here.
One-sided move.
Same stuff. Yeah, it always something happens, like here again, same stuff. 19 handle here, 19 handle here. Where is it? Here. Coming up, coming down. Boom. It's always something, man. All right, bro. I have to go. I got lots of missed calls, man.
Okay. So much thank you for this session.
No problem, man. Next week we will just, you know what? I will just send you some material. So if you have time on the weekend, you can just go through it. I think.
That's very thank you for that.
Yeah, man. So you can study, maybe you have some time. All right, bro. I'm gonna head out. Wish you all the best, man, and we hear from each other.
Okay.
All right. Bye-bye.
Bye bye.